Money isn't what you think it is. The numbers in your bank account, the price of your home, even the value of a dollar, it's all built on trust. And the second that trust cracks, the entire system trembles. Why is $1 not equal to £1 or 1 yen? They're all just paper. Because money isn't defined by what's printed on it. It's defined by the economy that stands behind it. When a country produces, innovates, and attracts investment, demand for its currency rises, its value goes up. But when an economy weakens, trust erodes, and when trust falls, so does the currency. Currencies are competing scorecards of economic strength. The number on the bill means nothing. The economy behind it means everything. So, if every major nation is in debt, who are they paying? America, China, Japan, they all owe trillions. They're paying each other and their own citizens. When a government needs money, it borrows by selling bonds. A bond is just an IOU. You lend the government $1,000 today, and they promise to pay you back later with interest. And who buys them? Everyone. Citizens, banks, foreign governments. The twist is, most countries never fully repay their debt. They just refinance it, issuing new bonds to pay off old ones. The system keeps running as long as investors trust they'll get paid. National debt isn't like your credit card. You can't repossess a country. It only becomes a crisis when trust collapses. So why not just print more money to pay for it all? Because printing money doesn't create wealth, it just dilutes it. Imagine a town with 100 people and 100 loaves of bread. Each loaf costs $10. Now the government prints an extra $1,000 and hands it out. People have more cash, but there are still only 100 loaves. Demand surges, prices explode. The bread jumps to $20, then $30. No one got richer. Everything just got more expensive. That's inflation. More money chasing the same goods. In 1923 Germany, people needed wheelbarrows of cash just to buy groceries. You can't print productivity, you can only print inflation. Which brings us to Bitcoin, digital money. No banks, no governments, just code. Bitcoin runs on a public ledger called the blockchain, where every transaction is verified and permanently locked in place. It's transparent, yet anonymous. No one can freeze your account, and no one can print more. There will only ever be 21 million Bitcoin. Scarcity is built in. But it's not perfect. Transactions are slow, prices swing wildly, and if you lose your password, your money is gone forever. No reset button. Bitcoin proves money can run on math instead of government trust. Whether that's the future is still unfolding. Now, imagine the opposite of inflation, falling prices. Cheaper groceries, lower rent. Sounds great, right? But deflation freezes economies. If you expect a car to be cheaper next month, you wait. Spending slows, businesses cut prices, so consumers wait even longer. Sales collapse, layoffs rise, and it becomes a downward spiral. Debt becomes deadly. You still owe $50,000, but your income is shrinking. Japan lived this for decades. Inflation hurts, deflation paralyzes. Let's talk about tariffs. When a government taxes imports, it sounds like they're punishing a foreign country. They're not. They're taxing you. If the US adds a 25% tariff on Chinese steel, the American company importing it pays that tax. The Chinese supplier gets paid in full. The importer then raises prices. That steel becomes cars, appliances, buildings, all more expensive. The cost ripples down the supply chain until it lands on the consumer. Tariffs are import taxes disguised as foreign punishment. This system also explains why so many can't afford homes anymore. 50 years ago, one income could buy a house. Today, two incomes struggle. The average home price has skyrocketed, far outpacing wages. Why? Supply is restricted by zoning laws and slow construction. But the bigger shift is that investors, corporations, and wealthy buyers started purchasing homes as assets, not as shelter. Homes became investment vehicles. Homes used to build families. Now they build portfolios. This brings us to the stock market, where there's two very different mindsets: trading and investing. Trading is short-term. Buy today, sell tomorrow, profit from the chaos. It's a sprint. Investing is long-term. Buy quality companies and hold for decades. When the market crashes, traders panic. Investors wait. One bets on movement, the other bets on time. And just like with stocks, the wealthy use debt differently. For most people, debt is a burden. For the rich, it's leverage. If you own $10 million in stock and sell it, you pay capital gains tax. But if you borrow against it instead, you get cash without selling. No sale, no tax. And all the while, your investments keep growing. If they earn 10% and your loan costs 3%, you profit. It's the same tool, but with opposite outcomes. Finally, there's money laundering, turning illegal cash into clean income. It happens in 3 stages: placement, getting the dirty money into the system; layering, moving it through complex transactions to blur the trail; and integration, bringing it back as legitimate profit. Laundering doesn't hide the money, it hides where it came from. All of this, from currencies to crypto to debt, runs the world. But beneath the surface, it's not paper or coins or numbers. It's trust. And the moment that trust breaks, everything gets repriced.